Hi, this is George Fieldhouse with Vector Financial Solutions, and the financial solution I'll be talking about in this presentation is how you can set up your own tax-free retirement account, a private plan where you can receive tax-free income when you retire and kiss the IRS goodbye forever. That picture there of me is when I was 18 years old, and retirement was the furthest thing from my mind. It seemed a lifetime away. But you know what? Lifetimes have a way of going by pretty quick, don't they? So my question to you is, are you ready for retirement? Because retirement may be looking a lot of us right in the face, and some of us seems a lifetime away yet. But you need to get started now. So you may have a retirement plan set up, and maybe a qualified plan, what's called a government qualified plan, and it's usually one of these animals right here. But what most people don't think about is that they have a retirement partner. And that retirement partner is looking over your shoulder. He's waiting for his taxes, and he's going to be there with his hand in your pocket when you get ready to retire. Well, we believe it's time that you fire your partner. Just tell him you're fired, because the truth of the matter is these private plans are a failure. Think about this. Is your retirement account, is it a savings plan for retirement, or is it an investment account? It's often referred to as a 401k savings account. Can you lose money in a savings account? I don't know. My savings account at the bank only goes up and down if I put money in or take it out. But a 401k, an IRA, market goes up, your account value goes up. Market goes down, your account value goes down. That sounds more like an investment plan. Do you really want your retirement funds in an investment plan where you could actually lose money? There's a lot of uncertainty in a plan like that. In fact, Time Magazine, in their cover story back in October of 2009, was why it's time to retire the 401k and what you can do instead. They said that the ugly truth is that the 401k is a lousy idea. It's a rotten repository for our retirement reserves. In fact, 52% of workers have savings of less than $25,000, not including their home equity, and we know what's happened with home equity. 75% have savings of less than $10,000, and 36% of those over 55 have saved less than $10,000. That's pretty sad. The truth is, most Americans will be too poor to retire at age 65, according to research at Boston College. Morningstar and Harvard Business School did a study of 4,000 mutual funds between 96 and 2002, and they found that the investors' return on investment net fees, after the fees were taken out, was only 2.924%. And then there's the years when there's bear market losses. 36%, 48, 27, 33, 42, and most recently from October of 2007 to March of 2009, a whopping 56.77% loss. That's pretty steep. The market since 1946 has an average loss of 33.21% every 6 years. And it takes 22.5 months for the index to return to its prior high value. That's not your account returning to its prior high value, which will take longer because you're starting off with less money now. Well, we also have to consider taxes. Taxes have to go up. We know that. We think the tax rates are high right now. Let's take a look at what they were before. In fact, they have to go up because in 2011 deficit is $1.5 trillion, 10% of the gross domestic product, and the largest since World War II. Total national debt, $15 trillion. A trillion. How much is a trillion? Politicians throw $1 trillion around very easily today. So how much is it really? Well, let's take a look and see what the difference is between a million, a billion, and a trillion. A million seconds is 12 days. A billion seconds is 31 years. Quite a big difference between a million and a billion. Well, what's the difference between a billion and a trillion? trillion seconds is 31,688 years. That's a huge difference. And we're talking about trillions of dollars of national debt. And this little guy here, he's saying, Mama, you're sticking me with how much debt? Oh, please, Mom. Well, recent high tax rates, we think they were high now. Well, in 1944, 1945, 94% was the high rate. 91%, 70%, 50%. Currently 35%. It's not looking too bad anymore, is it? The last time taxes were this low was 1931, and the last time the low rate was today's 10% was 1941, 70 years ago. So is there room for taxes to go up? You bet your bottom dollar. Question is, do you want to pay now, or do you want to defer your taxes to the coming higher tax rates? They have to go up. So you can pay now or you can pay later, but Uncle Sam wants his money. A lot of us know the story of Johnny Appleseed. He roamed the Midwest back at the turn of the last century planting apple seeds, planting orchards. And the government came along one day and they said, Johnny, you know, you have to pay your taxes. Now, we can do it one of two ways. We can tax you on those seeds that you got in that sack there, or we can tax you later on the harvest. The choice is yours. Taxed on the seed or the harvest. Well, this is tax deferred money, which is what a 401k is. You're deferring your taxes, not eliminate them, and you're going to be taxed when you start taking your money out. Or you can pay your taxes now and you won't be taxed on withdrawal because you already paid them. So it's the seed and the harvest. Do you want to pay your taxes now, pay a little bit, or do you want to pay them later on the harvest, which what a traditional IRA or 401k is set up for? So what's the answer? What can I do? Time magazine said the solution is a new type of insurance. Retirement savings, it turns out, is exactly the type of asset we need insurance for. And CNBC said the new asset class investment, talking about insurance, they said is a safe bet, long-term investment with high interest and almost no volatility, and very important, it's also liquid. So what is it? It's permanent life insurance. Most people don't think of using life insurance as a retirement vehicle, but if it's set up the right way, it really works very well, which we'll show you. For retirement savings, it's often called a private plan. It's approved by Congress, regulated by the IRS, if the Internal Revenue Code 7702. Stock market possibilities. Let's look at what can happen if you have money invested in the stock market. Let's say you have $450,000 in your account. There's three different possibilities, right? Your account value could go up. Of course, it could go down, or it could stay the same. It could be just a neutral year when there really wasn't much change from the beginning to the end of the year. Well, if you could eliminate one of those scenarios, which one would it be? It wouldn't be the up years, right? It wouldn't be the years when your account value stays the same, even though it's not as good as going up. It's better than suffering a loss. So the obvious thing is that you would want to get rid of the years when your account value went down. Well, if you could get rid of the down years, then your principal would be 100% guaranteed, wouldn't it? If you couldn't lose any of that money, your principal's 100% guaranteed. You see, your returns can be linked to the S&P or another index, but you're not actually in the market. This means you keep all your annual gains. Your principal and gains cannot go down in value because of the market. They can only go up. Well, how does an IUL work? Let's say you got $450,000 in your account and the market goes up 10%. Well, you capture that 10% increase and you're locked in now at $495,000. Pretty good. Well, let's say the market drops 40%. That was the average investor loss between 2000 and 2002. 40% loss. Well, remember, you're locked in, so you didn't lose anything. You still have $495,000 in your account. Meanwhile, your neighbor next door, he's got a 401k and his account value dropped to $297,000. And we all know people that this happened to as recently as 2008, 2009. Well, the market rebounds, goes up 6%. You capture that increase, and now you're locked in again at 524.7. But your neighbor next door, he would need the market to go up 66.7% just to get back to where he was before that 40% decline. 66.7% is needed for him just to get back to 495. Well, market goes up again 8%. You capture that. You're locked in now at 566. And once the market rebounds and it goes up that 66.7%, however long it may take, your neighbor is now back to 495. And meanwhile, you would have an account value of over $900,000 in that scenario. Which is a better plan? It's really pretty obvious. Take a look here at a chart. Dow Jones from 66 to 82. The red years are years when the market was down, suffered losses. The green years were years when it went up and you had gains in your accounts. And the blue years there are just neutral. There wasn't really much change from the beginning to the end of the year. Pretty much ended up where it started out. Well, what if you could turn all of those red years blue? Just neutralize them so you didn't have any losses. That would be a whole lot better. Well, how well can this solution work? Let's take a hypothetical look at the past 20 years. And I say hypothetical only because these types of plans haven't been around for 20 years. But the S&P index has. So based on actual S&P index gains, using current crediting formula and expenses, including the zero gain years, the net per year would have been between 7 and 8% return. 7-8%. Not very bad. It's not something where you're looking at huge gains like you would in the market, but you don't have any losses either. Remember, your account value can only stay the same or go up. So 7 to 8% net versus the market. The S&P 500 was 7.93 gross. Okay, less 3% in mutual fund fees. Most people don't think about those. 4.93% net. But with timing costs, because these fund managers, they don't always buy at the right time and sell at the right time, right? You're supposed to buy low and sell high. Sometimes they buy high and sell low. So Dalbar Incorporated, according to their results, according to their reports, they said the net investor return on investment was an actual 1.87%. 1.87 versus 7 to 8%. Result, after 20 years, the IUL would have outperformed the market by quite a bit. So let's look at a private plan example here. Let's say, take a look at a 35-year-old male, non-tobacco, standard rating. And if he's putting $500 a month into his plan, into a private plan now, monthly premium, up until age 65. And the way we set these up, we're not setting it up for the death benefit, we're setting it up as a retirement plan. So we're looking at a minimum death benefit, maximum cash value, the way it's set up, with an increasing death benefit over the years. First year death benefit would start out at $187,000 in this case. At age 65, he would stop making premium payments and not have them anymore. The death benefit at age 65 now has risen to $724,000, and he would be able to begin taking cash flow from his policy at $75,000 a year to age 100. Total premium paid $180,000, and the total cash from the policy through age 100, if he lived that long, would be over $2.5 million. So this is Indexed Life. It's the retirement savings investment for the future. It also has an accelerated living benefit with 1 or 2 year terminal diagnosis, up to $1 million in advanced benefit. This money can be used for any purpose, including treatment that could save your life. With Indexed Life, its other dramatic advantage is that you pay no tax on the gains ever. Your retirement income is tax-free, and it can be passed on to your heirs tax-free. You got that tax-free death benefit that goes to your heirs. Final truth, index life may be your last chance retirement. Qualified plans, you're subject to market risk, future tax increases, taxes on Social Security. Truth is, it's a sinking, broke retirement plan. Well, let's take a look at a scenario here and the difference between the seed and the harvest again. If you're putting $500 a month into your 401k or $6,000 a year for 35 years, let's say that you were lived in a perfect world and you got an average of 8% a year, your account value at retirement would be $1 million. And $1,800 taxes deferred each year, assuming you're in a 30% tax bracket and taxes didn't go up over those years, you would have deferred $63,000 in taxes. And at retirement, let's say you're still living in a perfect world and you're still getting 8% return on that $1 million, and you're just going to skim the interest off the top, leave the principal alone, and you're going to take out $80,000 a year. Well, here comes Uncle Sam with his hand in your pocket now. He's going to want his taxes. And so now, assuming taxes haven't gone up and you're still at 30%, that's $24,000 you're going to pay in taxes each year. Well, look at this. In just 2.63 years, the IRS got back all the money that was deferred. That $63,000 that you deferred over 35 years, you gave it back to them in less than 3 years. And after 10 years in retirement, you would have given them $240,000. After 20 years, $480,000. And people are living longer today. Many people are living into their 90s. So if you lived into your 90s and had retirement income coming in for 30 years, you would have given the IRS $720,000. And at your death, your heirs are taxed and would have paid the IRS over $400,000 to the government. So my question is, do you want to pay these taxes, pay taxes on the harvest, or pay these taxes over that 35 years, just paying on the seed as you were putting it into your account? So index life, to wrap it up, is retirement peace of mind. You can eliminate all future increased tax rate risks. You can avoid the market roller coaster anxiety, up and down of the market. You can feel confident about earning and keeping most future market gains. You can enjoy steady tax-free income. So who can benefit from these types of plans? Well, young singles can, just starting out in their careers. Young married couples. Young families with children. Professionals and small business owners. Grandparents for their grandchildren. You know, when you get older, the cost of insurance goes up quite a bit, and it's not practical for an older person to take out an insurance policy as a retirement plan, but they can take out a plan and have the coverage on a child, one of their children or their grandchildren, but they are actually the owners of the policy and control it. At a later time, they can assign the ownership to one of their children or their grandchildren, but they still have the benefit of using that policy themselves. And then you got guys like this that are just not real happy with their 401k. Hopefully these aren't one of your children. They don't look too happy. So we say plan today, protect tomorrow. And I'd just like to thank you for your time. This is my contact information. If you have any questions, if you'd like to set an appointment, I'll be more than happy to show you how this can work for you. And then we got the disclosure information here.